Die Inflation ist in Deutschland derzeit so hoch wie seit fast 30 Jahren nicht und sie erweist sich als hartnäckig. Die Kapitalmärkte stehen vor entscheidenden Fragen. Wie gehen jetzt die Notenbanken mit dem Thema Inflation um? Steuert insbesondere die Fed stärker gegen, als bisher von den Märkten erwartet und eingepreist? Ein Umfeld, das für Bondinvestments alles andere als einfach ist. Einmal mehr ist daher der Investmentansatz und eine systematische Umsetzung wichtig. Um diese Fragen geht es heute bei Fonds im Fokus, die wir gemeinsam mit Jupiter beantworten wollen. Herzlich willkommen dazu. Zugeschaltet aus London ist uns Huw Davies, den ich herzlich an dieser Stelle begrüßen darf. Hello, Mr. Davies.
Good morning.
Er ist ausgewiesener Spezialist im Bereich Bonds und seit 1991 in der Branche tätig. Seit Mitte 2020 im Fixed Income Team von Jupiter. Bei uns hier im Studio ist Jan Richter von FondsConsult Research, den ich ebenfalls herzlich begrüßen darf. Guten Morgen, Herr Richter.
Guten Morgen, Herr Schmidt.
Ich freue mich jetzt auf einen angeregten Austausch und darf an Sie übergeben.
Thank you, Mr. Schmidt, for the kind introduction. Today we are talking about the Jupiter Strategic Absolute Return Bond Fund. So please give us a first idea what an investor has to expect from this fund and what not to expect. Because there are many absolute return funds outside, there are strategic bond funds, there are total return bond funds. So what's your fund doing?
We're looking to deliver to investors a fixed income feel in terms of what the fund feels like within their portfolios. So returns derived from the fixed income universe, but actually with a low correlation because of the long-short nature of our product, with a very low correlation towards traditional fixed income funds, but also to risk assets, equities, and other parts of the fixed income world. So that's what we're trying to deliver to investors. But a key component of that, we believe, is to also deliver low volatility. So one of the key aspects that they shouldn't expect is high volatility from this fund. So we're looking to deliver fixed income returns, diversified and uncorrelated to traditional fixed income, but maintaining that low volatility that investors like from the fixed income portion of their portfolios.
The fund is new to Jupiter, but it has a long history under the old Mutual and Marian brand. Can you give us some explanation how this fund moved from company to company?
Yes, there's been quite a lot of change at the corporate level, but the strategy has remained exactly the same since it was launched back in May 2017. So that was initially with Old Mutual Global Investors, as I said, back in May 2017. That company transferred over to or rebranded as Marian, and then Marian was taken over back in July of 2020. We were taken over by Jupiter. So there's been quite a lot of changes at the corporate level, but importantly for our investors, there's been no change in the strategy, how it's operated over that period of time. And obviously we're coming up in May of this year to our 5-year anniversary.
During all those rebranding, the core team managing the fund stayed the same, or have there been any changes within the team?
We did have one person leave around the time of the takeover by Jupiter back in July 2020. But the core of the team has remained the same. We didn't hire anyone in to replace that person. We just had some reorganization of the team. So headed up by Mark Nash, the core of the team has remained exactly the same over that period of time. In fact, since back in 2017 when the fund was launched.
So please tell us more about your background, about the background of Mark Nash, how you work together, and have you worked together before you started managing the fund?
Mark Nash joined Old Mutual back in 2016. I was already there working for Old Mutual in the fixed income department, but for a different team. So we started to work together since that period of time. As I said, the fund launched in May 2017. Mark Nash is the lead manager on this strategy. He previously worked for Invesco, where he built up the investment process that we use within this fund. It wasn't used at that time for a long-short absolute return fund, but certainly was used for other funds. It is very transferable across a number of different types of mandates. So that's where he developed the process and brought it across to Old Mutual when he moved over at that time from Invesco. As I said, we worked from 2016 onwards on that. We had James Novotny, who's also a portfolio manager, who joined the team back in 2018. My background prior to working for Old Mutual was actually for investment banks. So I've worked in fixed income markets since the early 90s, initially for investment banks like Citi and JP Morgan, and in asset management, as I said, since actually late 2014.
And within Jupiter, is there a lot of interaction with the fixed income team and the multi-asset team, or are you some kind of own team that has its own decision making and doesn't talk to other guys?
Well, we have our own decision making process, but we've got within the team we've got a very flat structure, but also we've got a very open dialogue with all other members of the Jupiter fixed income and multi-asset team. So we have regular meetings scheduled every week within our diary with those teams, just to discuss the various views that we have, the macro views that we have across the desk. And we're in that situation where we have very open dialogue outside of those formalized meetings as well. It's a very open structure. One of the things that both with Old Mutual and with Merian and also with Jupiter, one of the key differences to some other asset management companies is we don't have a house view. So all teams are available to have their own views, both on a micro and a macro level. And that creates, I think, an environment where there's a very open level of discussion between the various teams.
And at the beginning, you already mentioned one of the aims of the fund is to have a low correlation and a low volatility compared to the fixed income markets. So is there a dedicated return target and a volatility range that you try to achieve?
We're really targeting a implied volatility for the fund of somewhere around 4 to 6%. That's not purely plucked out of the air. That's really designed to mimic or to replicate the price volatility of a fixed income fund or a traditional fixed income fund. If you look at medium dated government bonds, that's the sort of historic volatility you could expect from a sort of medium dated government bond. We're trying to replicate that. What we're obviously trying to do is offer diversification, particularly with very low interest rates in the traditional fixed income world at the moment. So we're looking to create an environment where we've got diversification away from traditional fixed income, but delivering a very similar volatility in terms of what it feels like from a price volatility perspective within investors' fund.
And on the return target?
We target a Sharpe ratio. So if we're targeting a price volatility for the fund of around 4 to 6%, then we should be delivering on an annualized basis, if we meet our target in terms of Sharpe ratio, of around 4 to 5%. We've managed to do that over the period of time. The Sharpe ratio is around 1. So we've delivered an annualized return of somewhere around, in US dollars, that is, of somewhere around 4 or just above 4%.
To achieve this return target, so what's your opportunity set? Where you can invest within the fixed income universe?
So we can effectively, it's a go anywhere set. So we view all parts of the sort of fixed income and currency world as part of our universe. So that includes developed market bonds, also emerging market bonds. We also look at foreign exchange. We also look at credit markets. So yes, any part of the fixed income and currency world we look at. We do have limitations on some of those. So certainly in emerging markets and in credit, we limit our exposure to around 20% of we do limit the exposure to 20% of the overall risk exposure for both of those classes. So we don't want to be, we never really want to be in a situation where we're over-reliant on any part of the universe in terms of our exposures. But as I said, the key component really for us is delivering those sort of returns, but from a very, very risk-controlled environment. We think the price or the volatility angle of any fixed income fund is an important component for investors within their portfolio. I think one of the errors or mistakes that some other funds in this space make is delivering a heightened level of volatility during periods, particularly of risk market volatility. So really what you want, we think the diversification from fixed incomes comes from a combination of returns, plainly, but also in terms of a combination of returns and diversified volatility, i.e. low volatility, particularly relative to risk markets. So that risk control is an important component of our fund.
And how do you find those interesting investment ideas in an environment of low interest rates and low credit spreads? So is it just purely bottom up, or do you have some top down view, use some macro themes, or how do you arrive on those ideas in the portfolio?
We're really a macro fund. We're not stock pickers, for instance. We do invest in the credit world, but what we don't try to do, we don't set ourselves out as specific as credit investors. Credit we see as a generic macro decision, i.e. that we believe that certain parts, like investment grade or high yield, are cheaper any part of the cycle, and we would look to invest in those in a generic beta form rather than into specific names. So we're really looking for generically credit to be either cheap or dear, and take views on that from a macro perspective. So it's very much a macro fund, and that's how we run it, and that's how we've run it for all of this time. It obviously in this low yield environment, or an environment where we've got very low yields across all markets, particularly in the developed markets, we're in an environment where that long-short aspect of our fund is a very important part of it. So really what we're looking for is to pick up on the major themes, macro themes through the cycle, and to deliver returns on the back of that. You know, the key for us is if we get we get some identifiable macro themes, and we're able to both identify those, but also to position the fund correctly, either long, short of various parts of the macro world, to be able to take advantage of that. So that's what we're really trying to do. So the opportunity set for us is that we're in an environment where there is movement across all these asset classes. And certainly, obviously, in the aftermath of the pandemic, and with interest rates or big question marks about the future direction of inflation and interest rates, then that, we believe, from a macro perspective, that's a pretty fertile and opportunity-rich environment. So, you know, we think that this is exactly, particularly as we've got an ability to go short of some of these asset classes and short of interest rates, then we've got quite a wide set to be able to deliver still positive returns, even if we see an environment where inflation and interest rates are rising.
Can you give us a current example of a macro theme that you use at the moment, and how this is transformed into portfolio positioning?
I think quite relevant really at the beginning of this year, in particular given the moves that we've seen in developed market yields, well, yields across the fixed income world so far this year. We believe that central banks led by the US Federal Reserve are now going to address the increasing concerns around inflation over the course of 2022. So we believe that the US Federal Reserve is moving in an environment where it's going to meaningfully increase interest rates over the course of 2022 and probably beyond, to address that inflation environment. And therefore, US rates will rise, and probably rise, in our assessment, more than is priced into the market over the period of this cycle as well. So we're currently short of the belly of the US curve, and expressing that view through being short of that, or a little bit longer dated. So we've got a bit of a flattening bias within that, and we're positioning for the market to have to reprice its thoughts about where the US Federal Reserve will move over the course of 2022 and 2023 and possibly beyond, and that the market isn't pricing in the full hiking cycle that will come to bear over the course of this year and 2023.
So you think the market is still underestimating the hawkishness of the US Fed?
If you look at forward pricing, we've still got negative rates going in. If you look at forward pricing going forward 2 years, you've still got real rates negative. And if the US Federal Reserve wants to properly address the inflation issue, and we think they do, then real rates being negative isn't part of that process. So if you look historically, if they've wanted to be in an environment where they're addressing either inflation or growth problems or excess demand problems, they've normally had real rates positive, or they have had real rates positive. In fact, if you look back to 2018, when they probably made a policy error in our judgment, we can talk about that, but back in 2018, real rates in the US, front-end euro real rates got to about 1%, and they're currently minus 50 basis points. So there's a potential for quite a meaningful move in real rates. Now that obviously could happen through repricing inflation as well, but we don't think there would be such a serious repricing of inflation over that period of time, i.e. repricing of inflation expectations in the market. And therefore, we believe that the move will come as the US Federal Reserve looks to change people's expectations about where rates are going to go, or where real rates are going to go. So that's the basis of our macro view. I think it's backed up by the narrative that is increasing from the US Federal Reserve, and we don't think it's been fully priced into the market. So from our perspective, from a macro perspective, there's an opportunity there.
And do you think that the ECB is going to follow the path of the US Fed?
Eventually, I think, however, the ECB will be slow within that regard. I think that is because one of the great concerns, I think, within Europe and some other parts of the world, like Japan, has been the concerns around deflation and creating a deflationary environment. I think, therefore, the ECB will be slow, or much slower than the US Federal Reserve, to move rates higher. But eventually, I think they're going to have to address the same problems. But I think it's probably pertinent, and it probably feels right for them to be slow within following that US Federal Reserve process. But we think that global interest rates are going to have to rise to reflect the increased inflationary pressure across the globe, because it's not specifically a US problem. We're seeing it in the US plainly, we're seeing it in Europe, and we're seeing it here in the UK as well. So I think all of these countries are going to, at different speeds, move in that regard. But the fact that they're all moving at different speeds allows us to have some opportunity to take advantage of that within the portfolio as well, and have a differential in terms of our exposure at various different parts of the cycle. So at the moment, where our view is very much predicated or concentrated within the US, at some point that will transfer to starting to price things more aggressively into the ECB's or the European market.
And besides interest rate markets, are there any opportunities on the FX side and the credit side at the moment, or we're more focused on the interest rate at the moment?
Interest rates are more focused on that at the moment. We have relatively light exposure within the foreign exchange world. Last year, we were sort of long of the US dollar, in particular in the second half of last year. We flattened that out and gone a little bit short of the US dollar, but our conviction levels around foreign exchange at the moment are lower than they were at the second half of last year. We are looking to see how those things develop at the moment, and see how things develop in the foreign exchange world over the course of the next few weeks and months, to see if some opportunities arise. If you're getting central banks moving at different speeds, there may well be some foreign exchange angle in terms of our perspective. But at the moment, that's something that we're sort of monitoring rather than expressing in any aggressive way. On the credit angle, we think credit markets look expensive. The difficulty with that and looking for some widening of spreads is that the timing of any sort of risk volatility is very difficult in our estimations. So what we think is that we will see some widening at some stage over the course of this year, but we're sort of more positioning to be flat of credit markets at the moment, with some looking for some opportunity for some widening on the basket of some sort of volatility event, to be able to take advantage of widening spreads at some point. But I think it's very difficult for us, despite the fact that default rates are exceptionally low across the developed world, in fact, across the globe, but across the developed world as well, in particular. Despite that, if you look historically at where investment grade and high yield credit spreads are, they're very tight indeed. High yield, we think, has an opportunity from a carry perspective to give a little bit of return to this year, but it's very much a carry argument rather than necessarily a tightening argument. But we do think that there will be events over the course of 22 which lead to heightened levels of volatility, some risk adjustment at some point, and it will be at that point where we probably look to take advantage of some credit spread widening to maybe pick up a little bit of credit exposure.
When I look at the performance of the fund, so 2019 and 2020 have been very good. Last year was not so easy. So what went wrong last year?
In the beginning of 2021, we had the reflation theme, which we felt was a very strong process. And really what, I suppose for us, what didn't work over the course of 2021 was in the second half of 2021, the macro environment became much more difficult to read, i.e. in terms of identifiable and very strong themes, as we got this sort of the early part of the year where central banks seemed to be very accommodative to the global economy and seemed to be happy for inflation to rise and to run above target, maybe for an extended period of time to readdress some of the problems that had previously been in the global economy and to support the recovery from the pandemic. And then that rhetoric in the second half of the year changed quite dramatically. We had the re-emergence of variants of the coronavirus or COVID-19. And that's what created, I think, a lot of volatility, but not a very clear macro trend within the environment in the market. So that's where we struggled. But I think going into 2022, that's why we feel more optimistic about performance this year, because we feel we've got some clear, identifiable macro themes. What we really try to do within the fund is really to deliver some meaningful performance for investors where we see periods of identifiable macro themes, and then we look to protect investor value over the course of periods where the macro environment looks much more difficult to read. I think, although it's a disappointing year in 2021, that's what we did. We had a small positive performance in an environment where yields effectively rose, or traditional fixed income delivered a negative performance. So it was a year where we were sort of protecting investor capital over that period of time, waiting for the emergence of more identifiable macro themes. And I think 2022 to us seems to be a year more akin to that.
Which role your fund can play within the fixed income part of an investor's portfolio?
As you highlighted at the beginning of this piece, the difficulty at the moment is we've got very low yields and potential concerns around inflation and rising interest rates. And therefore, for investors' portfolios, it's a difficult environment because you've got concerns about rising interest rates, higher inflation, and obviously within that environment, diversification within portfolios. So plainly over the last, 30 or 40 years, fixed income or traditional fixed income has been able to deliver great diversification together with very good returns over that period of time. But now yields are so low, and we might be going through a period where we get an extended rise in interest rates across developed markets, and particularly at the front end of the curve. Finding diversification and returns is going to be difficult. And therefore, we think about our strategy as a sort of fixed income fund for a new environment, i.e. a new low yield environment. So we're still looking, as I said at the beginning, to deliver a very a price volatility for our returns that feels like a fixed income fund, but that added ability to be able to deliver in all sorts of environments, particularly in a rate rising environment. So we believe that we'll be able to deliver for investors a proper, diversified, but low volatility return in an environment where obviously traditional fixed income is going to probably struggle, particularly if our outlook for the macro trends is correct. So, and really, if you look at the returns over the course of the last sort of 4.5 years, that's exactly what we've done, i.e. delivered price volatility very similar to fixed income markets, but with diversification away from traditional fixed income indices.
Thank you for your time. Thank you for your deep insights into your strategy, and all the best, and goodbye, Mr. Davies.
Goodbye, nice to meet you. Take care.